Welcome back, everyone. In this video, I'm going to be going over one of the best monthly dividend ETFs you can buy. And there are quite a few monthly dividend paying ETFs out there, but they basically fail to appreciate in value over time. So when we're talking about monthly dividend ETFs, the best ones, we want to see an ETF that pays you a good sum of money and also appreciates in capital value over time. And that's why I think DIVO, the Amplified CWP Enhanced Dividend Income ETF, is an ETF that fits both of those categories. It pays you a high dividend, it pays monthly, and it also has been appreciated in capital value over time. So I'm going to go over this ETF, its investment methodology, and maybe one of the potential disadvantages of owning this ETF. Before we get into it, if you do enjoy this content, leave this video a like to get this content out there to a wider audience, and subscribe for future content. So DIVO is an actively managed ETF of high quality large companies with a history of dividend growth along with a tactical covered call strategy on individual stocks. So you're getting income from two sources. It's dividend income and then also it's covered calls. Now that income is split between 2 to 3% from dividend income and then 2 to 4% from options premiums. And the anticipated dividend yield on this ETF isn't bad, with it being around 4.71%, which is right in line with some of the higher paying ETFs out there. There are ETFs, of course, that will pay quite a bit more, like JEPI or JEPQ and several other different ETFs, but those ETFs generally don't appreciate in capital value. Of course, JEPQ has given the run on the NASDAQ, but JEPI not so much. Now, the ETF has a total number of equity holdings of 25. So this ETF holds 25 companies, and it's pretty well diversified overall. The top 10 holdings you see are all quality companies: United Healthcare, Microsoft, Caterpillar, Home Depot, Procter & Gamble, JP Morgan Chase, Goldman Sachs, Visa, Apple, and Honeywell. All very large companies and all pretty stable. And this ETF is also pretty well diversified among sectors, with financials leading the way at 19.75%, healthcare, information technology, industrials, consumer discretionary, and consumer staples. And then a little bit further down, you do see energy, materials, communication services, and utilities. It touches on a good number of sectors out there, so sufficiently diversified. Although it only holds 25 companies, it is pretty well diversified among industries. Now, the fund managers of this ETF, this is an actively managed ETF, so they basically pick these companies on a financial ratio analysis, looking at their financial statements. So DIVO consists of 20 to 25 individual stocks, which are screened and adjusted according to attributes including market cap, management track record, earnings, cash flow, and return on equity. So these fund managers aren't just haphazardly picking various companies. They're definitely selecting these companies based on quality. And if we look at the market value percentage of each of these holdings, they are pretty well diversified in the matter of total percentage of the fund. So United Healthcare has 5.46, but if we go all the way down to Honeywell, it still has a decent weight in the ETF of 4.03%. So pretty well diversification in its weightings in its securities overall. And I'm just going to scroll down a little bit to give you an overview of each of these holdings. I'm not going to speak about these. I'm not going to say that out loud. I'm just going to give you guys a brief view, and we are done just like that. Everything that it holds below ConocoPhillips is a covered call, which it reports as its holding. So you definitely do see some good broad diversification among securities. And as you see, these are all pretty well large established companies that are, for the most part, good in quality. Now let's take a look at the ETF's performance, and it's going to be pretty apparent to you why I think that this is a great monthly dividend ETF. Over the past 1 year, this is up 11.61%. So solid growth in capital appreciation, and then you also do receive that nice dividend month. Now with JEPI, the asset did appreciate in capital value, but it only appreciated at 3.32% over the past year. Of course, you did get that nice dividend along the way, which is pretty high, but this ETF isn't designed to grow. So if you are younger and also want a bit of a dividend, I don't know if JEPI would be a good choice for you unless you're trying to diversify for different reasons. Now, SPHD, the Invesco S&P 500 Dividend Low Volatility ETF, this is a conventional ETF. it takes a bunch of high yield dividend stocks, 50 of them, and then that's how you get paid your dividend. And this ETF is up 10.93%, a little bit less than DIVO, but its yield is also less. So this ETF is another ETF that didn't really outperform DIVO during that time period. So overall, DIVO is a great ETF for capital appreciation and also dividend growth, but there is a major problem with this ETF, and that is its expense ratio. And I think that it's the only negative of this ETF. It is a bit high at 0.56%. So when it comes to even monthly paying ETFs, this one is a bit higher. A lot of dividend ETFs that pay monthly do have a higher expense ratio, but even up to DIVO's point, it's really not as high as DIVO. Please remember, if you did enjoy this content, leave this video a like to get this content out there to a wider audience, and also subscribe for future content. I decided to make a video on DIVO because I do think it is a good ETF among monthly dividend payers, and I think a lot of dividend ETFs out there that pay monthly, like JEPI or JEPQ, are covered quite a bit. So I wanted to give you guys a quality alternative that you could take a look at and kind of make your own investment decision. Anyway, thank you all for watching. I'll see you in the next video.